Good morning again, everyone. This is David Moore of IRA Advantage, IRAadvantage.com, IRAadvantage.net. And today's presentation is IRA investment options for the future. And we've got an hour to get through, a lot of information. And of course, after I put things together, I always want to add other things. So we'll be talking about a few topics that are not listed in the presentation, but I think that are timely. So I guess first thing I'd like to say is none of this is new. Self-directed accounts have been around since the beginning of retirement accounts. So it's just a well-kept secret. And it's really interesting to me because, one of the things that people look at is they think, well, gee, is it risky? Who's got my money? So on and so forth. And the bottom line is with a self-directed account, you're going to put the money where you choose to put it. So typically, if we've got a checkbook IRA, we'll talk about that term, but the money's literally going to be sitting in the bank of your choice. So instead of having it off with some investment firm someplace else, you've got that money sitting there in the bank of your choice, which is really a safe factor, a comforting factor for a lot of people. And that if you've got a solo 401k plan, for example, it's going to be the same situation. You're going to have a bank account in the plan's name and EIN, and that account's going to be where you choose to put it. So when we look at self-directed accounts, one of the things people really like is just the safety or the comfort factor of knowing where your money is, and to be able to do community-based investing too. I mean, make a difference where you are. My father-in-law used to be a very charitable guy. Shouldn't say used to be, he always was a very charitable guy, he's just passed. But I used to ask him, well, how do you decide what you're going to be involved with, what you're going to get work with? And he says, well, it's easy. Go and do things where you can make a difference. And with a self-directed account, you can literally make a difference in a community. So, just another reason that people are looking at this more so than ever before. But I think, if anybody watching the news, it's pretty entertaining right now. We've got a situation where you've got that Reddit group that's basically taken it to some of the firms on Wall Street, and it's going to be interesting where it all goes. But that Robinhood platform that was started to allow people, empower people with trading when they want to trade, they pulled that stock, and it'll be interesting to see what the repercussions of that are. But we always like to say, you've worked hard for your money. We're going to work hard to keep it yours. IRA Advantage is a sister company to Equity Advantage. Equity Advantage handles tax-deferred exchanges. It's been around since 1991. IRA's been around for the last dozen years. But IRA was the result of our 1031 clients honestly looking to further diversify their Wall Street portfolios. And we're going to talk about it a little further inside the presentation. But if you look at it, at our last count, there's roughly $30 trillion in qualified money on Wall Street. Of that, about 2% of it's in real estate, which does not, to me, sound like a very diversified portfolio. Most of that is, once again, in a REIT, which is a stock. And some of you, if we're talking to real estate brokers, I know there's quite a few of you out there. And we talk about UPREITs as sort of like the ultimate installment sale, but understand when you get into, let's say, an UPREIT, there's no way out. So you can exchange into an UPREIT, you cannot get out without tax exposure. But that's another presentation that we'll be having, and I just think it's another version of an installment sale. But one of the great things about self-directed accounts is we like to say you can invest in what you know, and typically you've got insider trading issues on Wall Street's situation. But if you're a real estate broker and you want to take your retirement account and further, expand your real estate portfolio, you can do that. There's nothing prohibiting it. And I hope that would give you an edge. If you're a mortgage broker, you want to make hard money loans, do it. I mean, you should have a great opportunity to do well there. So, rarely is it a situation when we look at retirement accounts, rarely is a situation where somebody can't make a given investment. Typically the issue is, whether the transaction's benefiting a disqualified party, and we're going to be talking about all those things. But I will not have time probably to cover questions. If you've got questions, please post them on the right side of the screen. There's a section there for questions. You can post them and we'll be responding to them after the presentation. If I do have time at the end, I'll get to what I can, but just plan to get answers after the presentation is completed. So once again, David Moore, IRA Advantage, and here we go. So first thing I want to say is a self-directed IRA, it's not a legally defined term. It's just a term that describes an account that allows you to go do what you want to do. And if we look at a self-directed IRA, for example, in the most basic sense, all we're doing is moving the account from a custodian that won't allow you to do what you want to one that does, period. That's it. And it's not something that's tricky. It's not something complicated. It's not something that's just magic. It's really just changing any restriction you've got today. And if I were sitting in a classroom with you right now and I asked for a show of hands, who in the audience has self-directed accounts? Well, I know a few of you do because I saw the list of people on here. So I know who has what out there. But often I'll have, maybe 50 people in a room, and I'll have, a dozen people raise their hand. And then I ask them who the custodian is, and I know it's not a self-directed account. It's typically going to be something that Wall Street considers a self-directed account. I was driving in the other day, and we advertised on the radio, and I heard an advertisement for self-directed IRA. And I know as soon as I heard who it was presented by, it's not a self-directed IRA. It's going to allow you to trade your own investments through their platform, but it doesn't allow you, true self-direction is an account that's going to allow you to buy anything the law allows. And you're not going to have to be working through that stuff. So once again, if we look at an IRA, in the most basic sense, we're moving from a custodian that won't allow you to do what you want to one that does. And it's not all or nothing. Use what you want to use in this capacity. If you've got a 401k plan today and it doesn't allow you to make the investment that you want, as long as that investment's legal, it's a plan document issue. It's not an issue of law and what is legal to invest in. It's simply the plan document. So as we work from custodian to custodian with an IRA, we're just going to look at a 401k plan and see whether the plan actually allows the investment. Believe it or not, quite often I'll look at a plan, somebody will say, well, gee, I've been told I can't make this investment with my plan. Can you put a new one together? And I say, well, let me take a look at the plan, and I'll read through the plan. And I've had actually discussions or arguments with administrators and trustees about what their plan actually allows people to buy. And in one case, our client was a CPA, an ex-IRS auditor, and it was in his best interest to have his current administrator make that investment because it was a time-sensitive investment. I literally had to argue with the administrator about what was possible, and at the end of the day, they finally acknowledged the investment he wanted to make was possible, but they were going to have to get it approved, which was going to take it out another 3-4 weeks. And ultimately, we ended up taking the client and putting a new plan together for him. But it was really amazing to me when I looked at that situation. Does the plan allow it? If it allows it, great. If it doesn't allow it, can we amend the plan to allow it? If we can't amend the plan to allow it, we're going to replace the plan. So if we look at either form, whether it's a 401k plan or IRA, these things are possible. Depending on what the source of funds are, we might have some restrictions there. Like I said, one of the big benefits of self-directed investments is you can invest in what you know. And if you think you can do that on Wall Street, ask Martha Stewart about that. But that's a whole nother story. So when and how can I create a self-directed account? And I think that's a great question right now, because we have a number of people that have been sort of displaced from the workforce. And if we're looking at IRAs, any IRA can be self-directed. We're looking at a 401k plan. If it's a current employer plan, you're probably going to be stuck unless you're 59 and a half or older. If you're 59 and a half or older, you can take an in-service distribution and move some money into a self-directed account. But if you're happily employed, current employer plan, under 59 and a half, you're going to be stuck. The reason I brought the COVID situation up is we did have some loan provisions that were possible out there. Talk to your tax people, because these things, at some point, I mean, if we look at COVID relief, we had some relief in the form of your ability to take some money out of a plan, higher numbers for longer periods, and maybe we'll have more of that. We had with 1031, we only had one extension issued, and that was it ended the middle of summer last year. So if you're considering something, you got questions, check with your tax people. If they can't give you an answer, give us a call. We'll be happy to look into it if we don't have the answer. But with COVID, we've got people that are changing jobs. If you change your job, instead of just rolling your 401k plan into the new company plan, why don't you self-direct the account? You get access to it. I've actually had people that own their own businesses step away from ownership, not not from ownership, but step away from the day-to-day job of running it for a period of time so they can get access to these funds. So we've got to look at what type of plan it is, if it's corporate plan, but as I said before, any IRA can be self-directed. And the bold at the very bottom, typically we're looking at investments. So I just want to talk about two things. We all hear ads on people flipping property, and we see those ads on TV, we hear the ads on the radio, and flipping property, that's a business. So it's not an investment. You can argue all you want over it, but you use the Clarkowski court case, 9 points used to determine dealer status. We're talking a 1031 context, money out of your pocket. We're going to be looking at that to determine what kind of tax rate you're looking at, depending on the period of time you hold and whether the property qualifies for 1031. If I look at retirement accounts, then I'm going to look at that same court case and I'm going to sort of look at it from a different context. I'm going to look at it and say, okay, does this subject our client to what's called unrelated business taxable income, UBTI or UBIT? And if it does, understand that, for example, you go out buy an apartment building with your retirement account and with an IRA or 401k plan, you're going to make that investment. That's an investment. Now, let's say that laundromat's done very well for you in that building. You say, gee, that's great. I'd like to go out and buy a laundromat. Well, so you go and do the same thing, but now you've got a laundromat, not an investment in an apartment building that contains a laundromat. So that laundromat is an investment, it is, but it's also a business. So that same situation, you may now be subject to that unrelated business taxable income. And that is not a reason to make a given investment or not to make a given investment. It's just one more factor to really look at when you're deciding what you want to do with that money. But we've got what's called a rollover business startup. So if you're in a situation where, let's say, you want to go flip property and you want to do that for a living, well, you can't use your IRA money to just go do that. That would constitute a prohibited transaction. Sweat equity is not okay. You cannot work on an IRA or 401k owned asset. So if you want to go flip property and you'd like to work on it, you'd like to be compensated, we're not going to use an IRA or 401k in the investment context. We're going to go out and create what's called a rollover business startup. And that means we're going to go create a 401k plan, create a C Corp. The plan buys the Corp then makes the investments, and you're employed by that corporation, which is a pretty neat deal. The franchise world's gotten a hold of that. They understand what you can and can't do. We've got, actually even Wells Fargo, we've done some deals with the SBA division there on rollover business startups. And, I think I saw a good friend, Kevin Geraci, out on our list of attendees today. And Kevin's a guy that's been in finance world for years and in different places he's been. He's one of the sources of non-recourse IRA 401k funds. So, and what I mean by that is if you're going to go out and buy a piece of real estate with a IRA or a 401k plan, it has to be non-recourse debt. And that means that the only thing a lender can do in a default is take that asset. And by the way, if you were a joint owner of the property along with your retirement account, you personally couldn't guarantee the loan and have it non-recourse to the plan. That also would constitute a prohibited transaction. So if there's a benefit to a disqualified party, then we have an issue there. One of the things that comes up over and over again, oh, is this risky, like I said, or is this new, or I've been told you shouldn't do it. And I'm convinced that CE a lot of times in the tax community is provided by Wall Street on this topic, because as I said, it's not new. It's not even hard. As I stated earlier, in a nutshell, you're going from one custodian to another if you're going to do a self-directed IRA. If we're looking at 401k plans, we're just going from one plan that doesn't allow you to do what you want to another one that does. And, it's not something that's tricky out there. Now, the downside, and this is what's interesting, is that, for example, as I said at the top, I've been handling exchanges for 30 plus years now. And rarely do I have a client come in the office. And it's really sort of strange to me because, people close a transaction, the money comes in, they've never seen us, met us in a lot of cases, and it comes in and sits here. Well, I might have handled exchanges for 10 or 20 years for a client, and then all of a sudden we do a retirement account for them and they're sitting in my office. And I ask them, I said, well, it's great to see you. How come I hadn't seen you till now? Well, this is my retirement account. And I really failed to see any difference there. I mean, it's really one of those things I've been surprised by in our time in this side of the business, is that people are much more conservative with this, even though it's sort of, locked into that account. Now, self-directed accounts, it's easy to get upset with your financial advisor about a loss in Wall Street, but you've got that scapegoat, the poor guy there, right? And it's just sort of like your escrow officer in a closing. He or she can only deal with what they've been given as far as preparation and documents, and yet they're the person always in the firing line. So you'll understand these things. But if we look at this situation, your ability to go do what you want and make these things happen, what'll happen once in a while is we'll put a self-directed account for somebody, and then I'll talk to them 6 months or a year later, and I say, well, how's it been going? Well, I haven't done anything. Well, why haven't you made that investment yet? Well, it's sort of scary. So with a self-directed account, you don't have anyone else to get mad at. All right, so the investments are up to you, and it's up to you to keep yourself on the tracks and everything else. If we've got a checkbook IRA, for example, or a solo 401k, you truly have the power of the pen. You're going to do what you want, when you want, as you want, and it's up to you to really be strong and careful and confident with what you're doing, and making sure that you're always thinking of that safety and understanding what's possible there. So once again, if you've got a Wall Street retirement account, your financial advisor is going to be taking care of stuff, and you've got he or she to get upset with. And if it's a self-directed account, it's all on you. But that's the bottom line. You want that freedom. There's some responsibility there. So why do this? I mean, why would you think about a self-directed account? You may have had money entirely in Wall Street for a long time, and you may have done very, very well. Really, it's just a question of diversification. As I said, sometimes it's a question of control or even safety for people. But usually I'm going to always say it's to diversify. That's what I'm going to encourage people to do. If we're looking at IRAs, understand that whatever we put in that self-directed IRA is going to be sort of encumbered with the other investments in that self-directed IRA. If you want to use that as diversification, it's not all or nothing. I would keep the money you want to keep in Wall Street with your current advisor and keep that money there working. And then I'd segregate the self-directed funds from that account. That way, if you did commit a prohibited transaction on the self-directed account, the Wall Street stuff's isolated. The other way that we have people trade is to move everything into the self-directed account, and then open a trading account at maybe Robinhood or one of those online platforms. But by doing it that way, if it's in an IRA, understand that a prohibited transaction with an IRA really is a costly mistake, because it treats the entire account as a distribution as of the first day in the year in which the indiscretion occurred. A 401k plan, on the other hand, it's only the money involved with the indiscretion. So, we really look at those things, and I'm going to have a different approach or strategy for people with IRAs than I am with 401k plans. But why do people do this? Tired of the stock market's roller coaster? Hey, we've had a great ride. Where's it going to be in 6 months? I don't know. I mean, just like I said, if we just look at that Reddit situation and what's going on there, you're going to see some changes, and I don't know where we go with it, but I would expect that we might have some ups and downs, more of a roller coaster in the next couple of years than we have had in the past few years. Greater financial control, it's up to you to do what you want to do when you want to do it with a self-directed account. I mean, as far as buying, selling things, figuring out the maturity dates, if you're buying real estate, then you're really in control of what's happening with that project. Invest in what you know. We talked about that earlier. Increased investment flexibility is a big one. Why not have an account that allows you to buy everything that the law allows, instead of something that just sticks you in a certain pool of investments? And that's one of the biggest things that people come to us for. Why wouldn't you want that? Why not have the account that allows you to do what you want within the law? All right. Increase investment and flexibility, take care of that. Real investments, not alternative investments. Now, this is one of my biggest bones of contention with this whole thing, is that for some reason the investment world considers real estate an alternative investment. Precious metals an alternative investment. Can anyone out there tell me an older investment than real estate or precious metals? They don't exist, and yet by calling them alternative investments, I really sort of believe that it makes it seem like it's a more risky transaction. Now, I was having dinner with some friends a while back, and we were talking about some real estate, and the gentleman was just saying, well, yeah, real estate's just sort of luck anyway, and it's anything but luck. I mean, most of the people on this call are real estate people. It's hard work, and especially when you've got the government fighting you on stuff. So when you look at what you can and can't do, I was always taught to answer 3 questions. What am I going to make? How am I going to make it? When am I going to make it? If I can't answer questions, don't buy it. But with real estate, I'm not banking on appreciation for a given return. The cream on the top is that we typically have that. Even gold, you're betting on appreciation or inflation to give you that return. So, stocks, you're betting that it's going to go up, right? Or if you're shorting it, you're betting it's going to go down. But if we're looking at what we can do with real estate or even a note, you can package that note to whatever the return and terms and so on and so forth you want to do. It's up to somebody to say yay or nay to it. So, these things that are alternative investments, I really cringe at the thought of having them considered, alternative investments. They're hard assets, tangible assets. And everybody out there, we all hear the ads for gold and silver these days. Tangible asset, inflationary hedge. What's real estate? It's the ultimate tangible asset, inflationary hedge. And you're not betting that it's going to go up to make you money. Community-based investing, we talked about that. You can make a difference where you are. Taking advantage of today's opportunities. Things change day in, day out, so why not have that? Tangible assets, great hedges, we talked about that. Security, further diversification, having the money where invest in what reduce risk, take care of that. If we want to talk about sort of maybe potentially increasing risk, if you want crypto, you can go out and buy crypto with your retirement account. There's nothing prohibiting you from doing that other than your current plan or your current custodian. So if you want to do these things, it's possible. And finally, we've got a new business, and we're looking at the rollover business startups. So what are the common objections here? So this is stuff that I hear all the time. I mean, it's sort of funny, but if you've been to my presentations before, you probably heard me say I was at actually an institutional Tennessee and Common company's presentation one night. One of the presenters, they had a couple of economists speak, and they had a CPA speak. And so I went up afterwards and talked to the CPA about his presentation on 1031s, and then he'd made some comment about retirement accounts and real estate. So I said, well, hey, nice job on it. And he asked what I did. And I told him, he says, well, I don't think it's a good idea to use retirement money to go out and buy real estate. I said, really, why? And I had the same discussion actually in New Orleans at a Federation of Exchange Accommodators conference with a CPA out of Florida. And he was sort of the same thing. And it's really strange to me. But I looked at it, and he said, oh, really, why? And he said, well, you lose long-term capital gains tax rates on that real estate investment. Well, that's true, but there's nothing you buy with a retirement account that's going to give you that. So anything that's in that account is going to have the same tax consequence. So that's really a moot point. You should just be looking at what's going to provide the highest, best, safest return on investment for you, and invest in that. Why have any more risk in your life than you actually have to? So that statement, if you're stating simply, am I better off take money out of my pocket to go buy real estate versus using my retirement account to do it? Yes, if you pull money out of your pocket, if you could only do one or the other, I'm saying pull it out of your pocket. You don't have to have the non-recourse debt. You've got interest deductions, depreciation. You've got the ability to hold it long enough for long-term capital gains tax consequences, or kick the ball down the road indefinitely with the 1031 exchange. At this point, we still have the stepped-up basis, so I mean, you swap till you drop. There's no tax consequence ever. So clearly, if you're only able to take and use one source of money or the other, use money out of your pocket. But that's not what we're talking about. What we're talking about is what's the best, safest investment for your retirement account. And although you don't with an IRA typically have interest deductions, depreciation, you may if it's a leveraged investment. That's another conversation, but typically you're not going to have those. But nothing else you own is going to have a long-term capital gains tax rate. You're not going to get those things. Okay, second objection typically we hear, cannot leverage it. Well, you know, we have margin accounts on Wall Street. We have the ability to get a leveraged investment in real estate with an IRA or 401k plan. It's just got to be non-recourse debt. So once again, you cannot personally guarantee it. It's not your investment. I think the best thing people can think about when we're looking at retirement accounts and buying things is, do not think of it as yours. If you think of it as yours, you're going to have a tendency to start getting yourself into trouble. If you think of it as Susie down the street and respect it that way, understand that anything that plan owns, it owns, or anything your IRA owns, it owns, it is not you. So any benefit of that investment goes back into the account, any expenses paid out of that account. And one of the great things about the retirement accounts, when you sell, if it wasn't a leveraged investment, you don't have to deal with 1031. So I shouldn't say that as a facilitator, but hey, that's true. Time's not fun. What about RMDs, required minimum distributions? This is a big one. This is one of the objections that we hear all the time. Well, what happens if real estate's not liquid? What happens if you get to 72? Yes, I said 72. It used to be 70 and a half. 72 years old now, you've got to take RMDs, required minimum distributions. Well, one of the big objections is, you know, what, real estate's not liquid, you got to take an RMD and there's no money to do it. Now you're going to have a penalty, it's a big problem. Well, not really. I think it's actually a big opportunity, because one of the things that we do a lot of with retirement accounts is people will make an investment that they ultimately personally want to own. So they might go out, buy that apartment complex, buy that, you know, strip mall, buy that mobile home park, whatever it might be, and ultimately or maybe it's a retirement place at the beach. Ultimately they want to have that thing. Well, you cannot use it in any way or benefit in any way until it's been taken as a distribution. Now, if you have to take a distribution, typically in a Wall Street deal, you're taking cash out of the account. You're going to pay tax. The cash is, if you take $10,000, you took a $10,000 distribution, and it's pretty clear that's what happened. If you take an in-kind distribution, you know, what's it worth, number one, and number two, if you're taking a minority interest in a property or in, let's say if we've got a checkbook IRA LLC, everything you own with the retirement account is owned by a limited liability company that has the trust company as its member. Well, you can jointly own real estate along with your plan. You can own it tenancy in common, or you can own it as common members of a limited liability company. So instead of taking a cash distribution, you could just take and have an assignment of membership interest in the LLC as a distribution, or you can take a tenancy in common interest in the property as a distribution. Either way, if it's a minority distribution, you can discount the value by up to 40%. So think about that. You can accelerate distributions while minimizing the tax consequence by taking in-kind distributions. So what this CPA gave me as an objection was actually something that I love to talk about, because I don't look at it as a problem. I look at it as a tremendous opportunity. Now, with every good, there's a bad. You take an in-kind distribution, you get those benefits I just mentioned. The downside is you're not receiving cash to pay the tax obligations. You've got to have, you know, make sure you understand what the tax obligation is going to be on any distributions in kind, and have enough money set aside to pay that obligation. And then finally, we sort of covered that loose interest deductions, depreciation, sort of talked about that on the first bullet. But the reality is, if you've got a leveraged investment, you got some non-recourse debt on it. The bottom line is income or gain attributable to other people's money with an IRA triggers tax exposure. Big difference between IRAs and 401k plans. An IRA, if you've got a property that's owned 50% loan to value, half the income and half the gain is going to have tax exposure. With a 401k plan, you don't have that. Now, if I go back, let's say 20, 25 years ago, there was a gentleman, Pat Rice, that had written a book on IRA investing many moons ago. And I had him speak to the CCIM group, you know, here in the Oregon, Southwest Washington chapter. And, you know, he was sort of pushing IRAs as an alternative to 1031. They are not. It's apples and oranges. And in fact, there's situations where IRAs would need to do an exchange. And if it's a leveraged investment, that's one of those situations. If you've got a leveraged investment and you've got debt on the property at the time you relinquish it, even with the Roth IRA, you'd have tax exposure on the income or gain attributable to that leverage. So 50% loan to value, half the income, half the gain would have tax exposure. So and that's a situation where maybe your tax people are going to look at interest deductions, depreciation. And I just want to say the tax liability in this situation is not yours, it's the retirement accounts. So that's something that's got to be clear in people's minds. I like simple. Okay, now many years ago, I actually was at a presentation, the Mart. I don't know if we're talking about people in the Northwest, you may be aware of the Mart, and it was sort of the good old boys years and years ago. They used to meet at Atwater's when top of the U.S. Bank building, and a whole bunch of people had been in the biz forever, and suit and tie, and it was a great group, and it's still a great group. What's left of it, it's been hit pretty hard with recessions and obviously COVID and everything too. But the Mart's the meaningful arrangement of real property transactions. Anyway, Rice had spoken at CCIM, and actually there was a presentation that he gave to the Mart too, and that was a day-long presentation. The CCIM one was an hour long. The Mart had a day-long presentation. Penske was involved with it, and had another CPA, Eric Wickstrom, he's a good friend out of Seattle area. And anyway, it was a good presentation talking about different investments, but it really didn't get into the nitty-gritty on how you do stuff. And I just want to say this is not complicated. You got two things you got to look at. If I'm looking at an exchange, I look at four things. You've got to have an exchange, something's given away, received. What's given received have to be of like kind. We have to satisfy what we call the napkin test for total tax deferral. And then we have to have continuity vesting. That's my world in the 1031 space. If we're looking at a retirement account, we're looking at a totally different situation. We're just looking at two things. What does a person want to invest in, and who are they transacting between or for the benefit of? That's it. It's not complicated. So don't get sort of stuck in the weeds with this stuff. That's what's important. What do you want to buy, and who are you transacting between or for the benefit of? And as I said, creating these things is as simple as moving your money from a custodian won't allow you to do what you want to one that does, taking a retirement account or a plan that doesn't allow you to do what you want, amending it or restating it, replacing it with one that does. That's it. So as far as possible investments, I said earlier, a truly self-directed account is going to allow you to invest in anything the law allows. IRAs can invest in anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. So, how often have you ever wanted to make an investment in any of those things? Probably not very often. So unless it's specifically prohibited, it's therefore allowed. The only things that are prohibited with an IRA are those three. If we're looking at let's say a solo 401k plan, the only restriction in those is collectibles. So it's just wide open as far as what you can invest in. So rarely is that investment a problem. What triggers the problem typically is transactions between or for the benefit of a disqualified party. So who's a disqualified party? Well, lineal ascendants, descendants, their spouses, or any person or any entity that has a controlling interest owned by one of those disqualified parties. So what I did not mention, if you look at the bottom in the bold, siblings, aunts, uncles, cousins, they're not disqualified parties. So you cannot loan to or borrow from your IRA, nor could any other disqualified party, but you could loan or you could buy a property for your sibling, but you couldn't buy a property for your mom. So, it's just people ask all the time, well, why is it that way? And I said, well, some senator wanted to do that, I guess. Who knows? But that's just sort of the way we look at it. So once again, what do you want to buy? Who are you transacting between or for the benefit of? Now, one other point I want to stress on this slide is that you can transact along with a disqualified party. You can't transact between or for the benefit of one. So what do I mean by that? If you want to go out and jointly own a property along with your retirement account, you can do that. You can own it either tenancy in common, or you can own it as common members of an LLC. Now let's go take a step further. what happens if you want to 1031 into a property that is to be jointly owned by your retirement account and you personally? Well, 1031 does not allow the exchange of partnership interests. So if we're going to use a 1031 and combine 1031 funds along with qualified money IRA 401k funds, then we're going to have to use a tenancy in common structure instead of a limited liability company. I actually like the tenancy in common structure a little bit better anyway. We might have lenders that might not. Talk to Kevin about it, but if you look at the benefit of the tenancy in common structure is upon disposition, you personally have the ability to 1031 out of it, just like you could 1031 into it. If we have it all owned by the limited liability company that contains you personally and your IRA or 401k, then we're going to have a situation where we either have to do an exchange for that entity or you personally going to have some tax exposure. So be aware that you can always transact along with a disqualified party. You cannot transact between or for the benefit of one. And as I said before, that UBIT situation comes in either when you're flipping properties, conducting business, that laundromat example, or if we've got some debt on the property. With an IRA, you're going to have tax exposure. The 401k plan, you will not. So what kind of real estate can you buy? Rental houses, apartment buildings, office buildings, retail centers, land, any property to be held for investment. Future retirement home would be fine. You cannot, you couldn't go out and buy a second home and use it. If there's a benefit, once again, to a disqualified party, that constitutes a prohibited transaction. So you cannot personally use or personally benefit, nor could any other disqualified party use or benefit from one of these investments. The cash flow, years ago, I had somebody call up. They said, gee, I want to self-direct. I want to go out buy an apartment complex. I'd like to, I need more cash flow. And I said, well, understand once again that apartment building, if it's owned by your retirement account, the retirement account is not you. So the only way you're going to have a benefit of that investment in the apartment building is by taking distributions of some of that cash flow, which if you're under 59 and a half, you're going to have a penalty doing. So it's one of those things where you're just diversifying your portfolio, and whatever's in there is going to be in there until you take it out. When you take it out, it's going to be taxable. So retail, any real property acquired with intent to hold for investment is going to be fine. You can't buy primary residence, second home, home for a disqualified party, or office building to be used by a disqualified party. So we couldn't go out and take your company plan, go buy the building that you're going to occupy. That's not okay. We could, I guess, use a rollover business startup to accomplish the same thing, but that's a whole different thing. So if you got a situation you want to bounce off us, please don't hesitate to reach out. We're happy to answer any questions you may have. So how are they created? I've said it a few times now. If we're looking at corporate plans, if it's a current employer plan and you're under 59 and a half, we're going to be stuck. All right. If you're over 59 and a half, then you've got access to money you can take in service distribution. Previous employer plans, we can always roll. If we're looking at taking IRAs and moving them into a 401k plan, for example, we cannot use Roth IRA money, and we cannot use a beneficiary IRA, which would be one that was inherited, to move into a, let's say, a solo 401k, but we can self-direct those accounts. Any IRA can be self-directed. So just wide open, any IRA can be self-directed. We're going to look at, you might have this whole laundry list of different types of IRAs that you might personally have, and it's up to you. Once again, this is not a situation where it's all or nothing. If we're talking IRAs, again, I want to stress, if we're talking a self-directed IRA, I'm going to encourage you to keep the Wall Street investments with your Wall Street people and move what you want to use in the self-directed world into the new self-directed account. Obviously, as cash flow builds up the cash reserves in the self-directed account, maybe you're going to shove some money back. You could just open a trading account with one of the online traders. If we're using a checkbook IRA, in the checkbook IRA LLC's name and federal tax ID number, that's possible. But the safest thing to do is just to shove everything back into your Wall Street Advisors account, and that way you've got two IRAs, and your Wall Street stuff's there, and your self-directed stuff is in the self-directed account. And once again, the reason I say that is a prohibited transaction with an IRA, means that you've entirely converted that account into a distribution as of the first day in the year in which the indiscretion occurred. Now, the cost of that same problem with a solo 401k plan is entirely different. It's just the money involved with that indiscretion. So a basic self-directed IRA, I've said it, I don't know how many times already, you're probably getting tired of hearing me say it, but all we're doing is going to move money from one custodian to another. What's that mean? Well, typically the easiest way to do it, if you're working with us, you're going to fill out a 2-page application. You're going to turn that in along with a current, your most recent, if we're talking IRA to IRA, your current account's most recent statement, a copy of a photo ID. We're going to take the information, put it into a bunch of forms, get them out to you, and you'll just get back to us. We need wet ink on the next set of forms. One of those forms is a transfer authorization form, which allows the new custodian to go to the old custodian and say, give me the money. And as I said, it's not all or nothing. Your responsibility is to go to cash in the amount you want to use in this capacity. So you're going to, again, not all or nothing. You're going to decide how much you want to use in the self-directed. You're going to fill out the forms, get them back to us. We're going to establish the custodial account, and you don't need us. If it's a basic self-directed IRA, you don't need us to do that. If you're going to make an investment, a single investment that's, let's say, passive, maybe you want to buy into a fund, or maybe you've got some friend that's doing a business startup, and it's a single investment, one time, not time sensitive. A basic self-directed IRA is going to take care of you, and I'll further define the difference between basic and a checkbook in a minute. But really, you can just go online, fill out one of these accounts online. So, really, you can do it pretty quickly. Figure it's going to cost a couple $100 to do it. If you want us to do it, we're going to charge you $450, I believe, and it means you're paying us a few $100 to take care of the whole thing for you. But one of those forms, like I said, is a transfer authorization form, which allows the new custodian to go to the old custodian and transfer that money. And then to make an investment, you just submit the investment to the custodian along with a few other forms, and then they'll make the investment. So a basic account, just so we're all on the same page, a basic self-directed IRA means that you work with the IRA custodian for any investment. You have to submit the investment to the custodian. They will approve it or disapprove it. It's not based, that approval is not based upon whether it's a good investment. It's merely whether what they perceive to be a legal investment. So to make an investment, you can submit that investment along with an investment authorization form, prohibited transaction form, and then they're going to take, somewhere they might say they've got 24-hour funding policy, but our experience right now is that expect the better part of a week. So that's what happens with a basic account. If we're talking real estate, the deeded owner of that property would be the trust company for benefit of your IRA. Now, if you're a real estate broker, you're probably scratching your head a little bit, that you're saying, gee, how do I write an offer for somebody in this? Because technically the owner of that property is going to be the trust company, and the person you're working with doesn't have the power of the pen. Well, you're going to be happy with a checkbook IRA, not a self-directed IRA. So checkbook IRAs have been around for quite a while now, based on the Swanson case in 1996. But really, if you look at this bubble chart, the source of funds, just like any other IRA, we're still creating that new. So if we take a look at where it says IRA, 401k, or Roth, we're still going to take that. Those are just a source of money, source of retirement funds. We're still going to create a self-directed custodial account for a checkbook IRA. So I want to stress, just because you have a checkbook IRA does not mean you do not have a custodian. You always have a custodian with an IRA. With a checkbook IRA, you've just eliminated the custodian from your day-to-day activity. So if we look at the previous page, a basic account, you're going to have those different accounts fund the new self-directed account, custodial account, and then to make an investment, you submit it to the custodian, and then they'll make the investment. A checkbook IRA, we're adding that new IRA LLC, inserting it between the trust company and the ultimate investment. The trust company is involved with one investment. So the trust company custodian, I'm using them interchangeably. They're involved with one investment, the membership interest in that limited liability company. So if we look at that new IRA LLC, the member of that LLC would be the trust company for benefit of your IRA. The manager of that limited liability company would be you. So as the custodial account's being established, money's moving across, we're going to put the limited liability company together It's got an IRA-specific operating agreement. And then as soon as we get the IRA, we're going to get you the articles, the operating agreement, federal tax ID number for that. You're then going to go to the bank, open a checking account in the LLC's name and federal tax ID number. You as manager are going to be signer on that account. As soon as you get the account open, you're going to get us the account information. We're going to direct the custodian to make the investment into that limited liability company funding that bank account. The custodian's now done. The only interaction you're going to have with the custodian going forward is if you're moving money in or out of that limited liability company. So any additional contributions in the future are going to go through the custodian to the LLC. Any distribution would go from the LLC back through the custodian to you. So there's never going to be a transaction between that IRA LLC and you directly. Remember that. Don't name your LLC if you're John Smith, John Smith's LLC. I want that LLC named something that anytime you see that name, it is painfully clear in your mind, this is not you, this is your retirement account. Do not treat that thing as a piggy bank. If you do, it's going to convert your entire account and distribute all funds, and you now have, depending on how old you are, full distribution of the account and a penalty. So very important you keep that in mind. But as soon as that LLC has been funded, now to buy whatever you want to buy, if it's a piece of property, you're just going to negotiate a deal between the seller and the limited liability company. You earn some money, you write a check. You go to close on it, write a check. Cash flow off the assets is going to go into that account. Any expenses paid out, you go forward, sell the property in the future. Property sells, money goes back in the LLC's account. Annually, your only involvement with the trust companies to provide them valuations of all cash and assets that the LLC has in that year. So they have no idea what's going on, so they want somebody to tell them what things are worth. When you get to RMDs, it's critical that those numbers are, are valid numbers, good numbers. Now, when I just want to stress, we work with a variety of self-directed custodians, and there's probably a dozen big ones coast to coast that have been in this business for a long time. And the thing that's different about a self-directed account, you see what everything costs. But when you're looking at a self-directed custodian, I think it's important that you're paying somebody that their fees are based upon, let's say, number of investments, not the value of your account. Because if you're paying them based upon the value of your account, now you're adverse them every time you're providing valuations. I really have a problem with that. I've seen too many times where I've got a client that has that situation. I had a client, for example, in the last crash, had about $1 million note. It had gone south. Not legally speaking, but it was done. We all knew it was done, and yet the trust company was wanting to charge based upon $1 million when it was worth zero. So I much prefer one that's charging on the number of accounts. And as I said, with a checkbook IRA LLC, there's only one or number of investments. With a checkbook IRA LLC, you only got one investment. Now, one other thing I want to mention here, that IRA LLC, you might have traditional money, you might have Roth money. And for those of you out there that might have some questions on the difference between the two, traditional funds are pre-tax money growing tax deferred. You're going to pay normal income tax at the end of the day on distributions. Roth money is tax money that's growing tax free. Now, even with a Roth IRA, if you've got a leveraged investment with a Roth IRA, you're still going to have tax exposure. So that income or gain attributable to the leverage, other people's money, you'd have tax exposure in that situation. Just wanted to be clear on that. But that IRA LLC could contain a single IRA, it could contain multiple IRAs, and maybe you're married, so you and your spouse have each have an IRA, and you'd like to combine both of them into that IRA LLC. We can do that. That's not a problem. If that IRA LLC contains disqualified members, then the entity is static after the initial funding. So when we have, once again, that IRA LLC, if we've got, let's say you have an IRA, a traditional and a Roth, and maybe your spouse has a traditional, and you'd like to have your traditional Roth and your spouse's IRA in that entity, we can do all that, but you cannot make additional contributions to that LLC in the future. So I would say if you want to combine variety accounts into that one LLC, we want to overfund that initial investment into the LLC. We don't want to say, okay, you're going to go buy this $200,000 property, and so I'm putting $205,000 in there. I'd like to see you put, let's say, 230 or something in there, so you've got some money in case there's a problem going forward. So once again, transacting between or for the benefit of disqualified parties is prohibited transaction. Transacting along with a disqualified party is going to be fine. So how about a solo 401k? Okay, if you are self-employed and you do not have any employees, so even part-time employees, I'm going to suggest a solo 401k. And you know, for real estate broker without employees, they're great. Basically what we're doing here, you don't have to have a trust company involved. We're going to create a new 401k plan. The money's going to move from wherever it is today. We're going to provide the plan and the federal tax ID for that plan. You're going to go to the bank, open an account in the plan's name and a federal tax ID number. You would then direct the investment or not investment, but the rollover or transfer of funds into that. So you'd just be rolling IRA funds into it, or moving funds from a previous employer plan into that account. And now you've got, just like the checkbook IRA, you've got a bank account in the plan's name and EIN, you as trustee or signer on that account. It works just like a checkbook IRA. The differences are that you don't have that custodian, so you have a little less cost. By the way, a checkbook IRA, you figure, it's going to cost you a couple thousand typically to put it together, and it's going to cost you normally $500 to $700 or so a year to keep it going. When you're looking at custodial fees, state registration fees for the limited liability company, whether you have a registered agent or not, and then there's a review that's required with the checkbook IRA LLC, depending on what custodian we're using. A 401k plan, you're just looking at annual amendments or restatements. So really, they're about $300 a year to keep going. Another benefit, you can borrow against them, half what's in it to max 50,000. Those numbers have been changed a little bit with COVID. Talk to your tax people about that. You've got greater flexibility. You can buy anything other than collectibles, and you've got your contribution limits on a solo 401k and, let's say, checkbook IRA are clear up into that mid 50,000 range, income dependent, but they're going to offer you the highest ability to contribute. Another thing I like about it, let's say you work and your spouse works with you. I mean, those of us that are married, we often have our spouses working. If you're a real estate broker, your spouse is probably helping with bookkeeping or something like that. So you could actually, if your spouse works for the firm too, you could have one account, one plan account for the two of you, which really is helpful and makes things very, very easy to work with. One of the biggest things I like about, well, two of the biggest things I like about the 401k plans, you don't have the tax on leverage, and the cost of a prohibited transaction with the 401k plan is just the money involved with the indiscretion instead of a complete conversion of the account. So that's a big one. So we talked about this. IRAs, can IRAs get a mortgage? And contrary to some people's belief, yes, they can, but it's got to be non-recourse debt. Again, what a typical non-recourse loan is going to look like, and if you've got questions about this, you can look at, I believe the domains myiralender.com or iralending.com. North American Savings Bank is one of the big banks in that business. But like I said, I saw Kevin's name on the list of attendees, and when he was with Opus, or is at Opus, I've got to keep track of him. He moves fast. He likes fast cars and he moves fast. Anyway, but I'm just joking. He sticks around with the company for a long time. But anyway, so Opus had a non-recourse program, and we're always looking for sources. It's a lot easier to get them source probably for commercial stuff than a lot of the residential stuff, but it's got to be non-recourse debt. In a default, the bank can take that property. Think you 60-65% loan to value is going to be the most you're probably going to see. Most of the time, they're going to want to see maybe 15% reserves, and they like to see people that have background in real estate. They don't necessarily want to go out and make a loan to somebody that's never had a piece of real estate and do it non-recourse. So understand that you're not going to get it through your normal course, but they are out there. And the only dumb questions I always like to say are the ones unasked. So if you're needing help in that space, not getting what you need, you can reach out. We'll do what we can to help you out. Contingencies on the purchase. Purchase sale agreements, lending provisions, let's say in the purchase sale agreement. It talks about lending provisions, but we want, if you're going to get a loan, we want to make sure it states something about, the non-recourse IRA 401k compliant loans that are necessary. If we're talking about a basic account, we need to make sure that we've got a contingency in the purchase sale agreement stating that the purchase is subject to the custodian's approval. You don't want to have money on the line and have the custodian say they're not going to do it. And then depending on what you're doing, you need to make sure that the account is set up. If you're a broker working this capacity, you need to understand it's going to take 2 to 4 weeks to get the account established, funded, and have money ready to go. So you want to make sure that you are ready to write an offer, that the investor is ready to write the offer when they go to do it. You can't personally tie the property up and then assign it over to your self-directed IRA 401k plan. That would constitute a prohibited transaction, because the plan benefited by your taking the property off the market. And then how do you even replace the earnest money there? So, my advice is anytime you're looking at this, people hear our ads, they call up, they ask questions, get information from us. We don't hear from them until they all of a sudden find the property they want. And then we have to say, look, it takes time. And we tell them that initially, but really take the time to get where you want to go. This is not something, it's your retirement. Like I said, you should be more conservative with it. And just make sure you're taking the time to understand what you're doing and be ready. But unlike real estate, real estate, you're happy, you put a property in the market, you're happy when it sells. Wall Street is really tricky because even during the day, you might have your accounts fluctuate in value so much that you might commit to doing this, but then funding that thing, what happens if the market dips? And then you say, well, gee, I don't want to take the loss right now. You want to wait till it gets back. All these things affect the timing of that transaction, your ability to move forward, the funding of the accounts to make it happen. So really take the time, figure it out early, and get where you want to go. Selling the property, you're going to sell it as you normally would. Unlike tax money, if you didn't have leverage on it, you don't have tax on disposition, and the money's just going to go right back in the account, sit there until you're ready to make the next investment. You don't need to do a 1031 exchange. Businesses, as I said before, we can even do business startups. So in this situation, we've got to look at the source of money. As I stated earlier, can't use Roth or beneficiary IRAs to fund a 401k plan. But anything else we can roll into 401k, and then obviously previous employer plans, we can move into that thing. We do encourage. So in a nutshell, what happens here, we're going to move the money from the old source, the old retirement source, into the new 401k plan. We create a C Corp. It has to be a 401k plan, a C Corp. The 401k plan buys shares of the Corp makes the investment in the business. Now, we require our investors, our clients, to put 5% personal funds in there. We do it for a variety of reasons. But you're in there, and that could be a contribution in kind. For example, years ago, we did a mattress company. And the gentleman went out, he had to get his business set, leases set, everything going. So he went out, bought a couple trucks, and in advance of the whole thing being finalized, and he just contributed the trucks to the corporation and received shares of the corporation attributable to the equity in those trucks. So in kind, you might have a current business that you want to make bigger. And so you're capitalizing the new venture with your current business and a new rollover business startup. And that's totally fine too. We can do that. We had a gentleman we did a rollover business startup for with sports memorabilia. And that was an interesting thing because, what's that stuff worth? So you got to have a hard valuation of those assets if you're contributing things in kind for a business startup. But these have been great. We've done everything, like I said, from mattress companies to gold, silver, palladium mines. We did an Alaskan fishing operation, car dealerships, all kinds of stuff. So lots of real estate investment companies, but you name it, you can probably do it using this process. Few examples and we're done. All right, so this first example here, we're just looking at people's ability to make investments and do what they want to do and diversify. And so, when we're looking at I had a broker one time that was in a presentation, and I should have put that example in because I actually like it better than this example. But she came in, she ended up doing a solo 401k, and her first investment was with somebody that a builder developer that ran out of money and couldn't finish the projects. The kitchen was done, bathrooms weren't done. She just said, hey, look, if I make this investment, if I buy this property from you, I'll pay you to finish this thing, and I'll give you. She said in her situation, I think she said she'd give the guy a third of what her profit was in that situation. So it was a great situation, and made it happen, and really saved the builder, got the deal done, and had a great return on investment. In this situation, these people, husband and wife, they're living in a subdivision, had a newer house, and all of a sudden, the lot next to them comes up, and they didn't want somebody just building on it and having something they wouldn't have any opportunity to have any say on. So what happened in that situation is we combined their accounts. They didn't have all the money to make the initial investment up front, so we had the wife's account. We, as I said, a multi-member with disqualified parties as members in the checkbook IRA, we have to overfund the investment. So we had some additional money coming in via a note that was to be paid out over the next few months, and that was fine. So we bumped up her interest with additional cash coming in, but it allowed them to buy that property that was adjacent to the house. Now, I'll caution you, you can't go put a pool on it or park your cars on it or anything like that. If you're audited, somebody found you did that, that's a prohibited transaction. So that investment in that dirt was purely a speculatory investment in that property. If they had additional money later and they wanted to go vertical on it, they could, that would be fine. But you cannot use that property. It's not yours, it's your retirement accounts. If you benefit, that's a prohibited transaction. Second situation, this gentleman actually, I laugh. He's an old friend of. He's not an old friend. He's just a friend I've had for a long time. But anyway, he does our radio ads, and I think his best investment was actually starting to work for us doing radio ads through the time, and he had us do a self-directed for him. But he had a friend that had a development at the beach. The guy was having a hard time getting rid of stuff, and he said, hey, this is an opportunity, sort of like that broker I said bailing the builder developer out. In this situation, what happened is they came in, and he ended up buying into the dirt, which gave his buddy an opportunity to get rid of one of the lots, and he just sort of did it. He wanted to try get his feet wet in the process. During the ensuing years, he actually, a lot of times people would sort of dip their toe in the water, and that's what he did. So he got into it, said, okay, hey, this is going to be what I do first. And then he started asking around what our clients were doing. And some of the ads we were probably running were using content from other investors. And so he ended up buying into a multifamily project. It was a home run deal for him. So he started with a little, moved a lot more in later, and we have been working with him now for, actually he was working for us before we started the firm, but over a dozen years now. Next example, builder developer, land banking. Now, I was talking to builder developer the other day, and he's, I hate that term, whatever it is. But in this situation, this guy came in and had an opportunity to buy a bunch of land, dirt cheap, right? So the deal is he's builder developer. So in his situation, we could put a checkbook IRA together, is what we did. We put that together. He went out and bought land. He didn't know when he was going to build on it. And he wanted to be able to develop it. Now, he could not do that. As I said earlier, you're probably scratching your head saying, gee, the benefit to a disqualified party is a prohibited transaction. So in this situation, what we did is we did the checkbook IRA for him for the land bank. And then we put a second limited liability company together, and his ownership of the second LLC was 1/6, and that was the development entity. So at 1/6 ownership, that new entity was no longer a disqualified party to his retirement account. So as things were to be built out, the development entity would buy, from his land bank entity, and they go vertical on it and then take care of it. But that was a great way to maintain a portfolio of properties for future development without having to pay all the carrying costs that a bank might have charged. And it was a great opportunity to diversify his retirement account into something that he knew and understood. Take the risk out. This situation where these people, this guy's great, and he came in and he originally wanted to buy a mobile home RV park, and if you've been in my class, I give this example all the time too. But but he first wanted to buy, the property. But he's a guy that has a whole bunch of income properties. He was tired of the terrible T's: toast, trash, tenants, turnover. So, we all get to a point where we don't want to deal with the tenants in that situation. And so he first asked about the mobile home RV park, and then the next day he called up asking about notes, and we ended up putting a checkbook IRA together for him. First investment was a tiny one, and this was during the last crash down in Palm Desert. And the first note he bought was paying him 11%. It was only $35,000 on a $70,000 property that had been $200,000 pre-crash. So, he was hoping the guy would default on that situation, but it was his first, and he started off small, just moved a little bit of money in the account. Over the next couple of years, we moved several $1 million into his IRA accounts, and he ended up, I think the best investment he made was like a wind power farm, or I can't remember if it was wind power or solar down in the desert. They needed, I think they needed $900,000, paying 19%. It was like a 10% loan to value or something like that. In that situation, he was just hoping they'd default on it. But, notes in his situation, it was just further diversification. He wanted to be, that debt component, not the equity, and that gave him the passive investments versus dealing with the terrible T's. This is a bailout situation. So you couldn't take, so this guy comes in, builder developer, and he was having a hard time. I put this slide in because we might have people that have had investments. Maybe they have something in a state or a county where the politicians have said, gee, the tenants don't have to pay, and nobody's telling the bank to sit back, and now the guy's in trouble because they're behind on debt service, everything else, and now you've got a major problem. So this is a way to bail out a property, and so we did this a few times during the last crash. In this situation, and I sort of think of what I talked about when creating a new rollover business startup, contributing an old business into it. So in this situation, you could not take the builder developer having the problem, the property is going to go away. He asked if Dad's IRA could be used to pay the debt off. The answer is no, you can't do that. It's a prohibited transaction. There's a benefit to a disqualified party. Junior's a disqualified party to Dad's retirement account. So what we did is we created a new limited liability company. Junior deeded the property into it. And as you can see in here, it was a $3 million property, $1.2 million loan. So he got $1.8 million membership interest in the new LLC. Dad's IRA then put, I can't remember the exact number, but it was roughly $1.8 million too. And so now the members of this new LLC are Junior and Junior's dad's IRA LLC, which since that entity has the property and the cash from the IRA investment, that entity now has the property and the cash to pay the property off, which it did. And then going forward, it ended up going vertical, building out the apartment complex they wanted to do. But that was a situation where it was going to be, a real problem, and ended up a great opportunity for Dad. And, it really took care of big problems and provided a real opportunity going forward for Junior. Last example, all right, this is a rollover business startup. So it looks like a real estate investment. That's how it started. People came in, said, gee, I want to go out and take, it was his and hers retirement accounts, IRAs, wanted to combine them both to go buy a mobile home RV park. We started looking at a checkbook IRA for these two. And then they said they wanted to, live there and be the on-site managers. So they wanted to be compensated and live there. Well, either one of those things would trigger a prohibited transaction with an IRA. So we shifted gears, created the 401k plan, the C Corp, moved both IRAs, his and hers, into the new 401k plan. Plan buys the Corp bought the park. They got an investment, a job, and a place to live, all with that one transaction. And I just think that's a tremendous success story. So, investor's checklist. You can plan ahead. It takes 2 to 4 weeks to establish your self-directed IRA. You can purchase all types of property with an IRA, SEP IRA, Roth, doesn't really matter. You can purchase with family members, friends. You cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy a property with a mortgage, negotiate for the deal's inception in the IRA or IRA LLC's name. Don't overextend. Plan on keeping a nice cushion for reserves. Real estate is a real investment. It's not an alternative investment. These are our services. You can take a look, and the next page we talk about actually IRA Advantage, what we're doing today. 1031exchange.com's equity advantage for 1031s, and then property listings. We've got a post 1031 website for property listings. If you've got questions on different things, you can take a look at our YouTube site. We've got content. If you type in Equity Advantage 1031, there's all kinds of different issues discussed there. Everything from obviously 1031s to, we've got them on life contracts even. We've got them on cost seg. We've got all kinds of things on there. So you've got opportunity zones. But you've got questions. If you're looking for information on something you don't see on our YouTube channel, give us a call, shoot us an email. We'd like to hear from you. Same thing with IRA Advantage. We've got the site up there, the YouTube channel for IRA Advantage. It'll take care of you. Just heads up, lots of talk about 1031 and it being on the chopping block. We've got a presentation going on the 17th. The speaker is the governmental affairs officer for Inland Private Capital out of Chicago. And we've got some inside information there. Really, it's tough to do anything with tax measures right now since we really don't know anything. Any of the proposals we've seen were pre-COVID, and it's a different world. So until we get things, keep an eye out and for information from us. If you're not on our email list, don't hesitate to reach out to Seymour at IRAadvantage.net. She'll get you on there. But keep an eye out on that information, and I think that'll be a good presentation next month. And as I said earlier, only dumb questions once not asked. So thank you for attending today. I apologize, we're almost 10 minutes over, but hope you found it helpful. And I will be getting to the questions as we get information back to you. The video will be posted, and you will have access to a PDF of this presentation. Thank you, and best of health to everyone out there. David Moore for IRA Advantage, signing off. Bye-bye.